Hello, everybody. Great to see you today. I'm Lisa Sunin, and I'm looking forward to moderating this panel on digital health investing. I'm here with a couple of my colleagues and let them introduce themselves. Why don't we start with Marissa?
Hi, I'm Marissa Schlueter. I'm a health tech investor at OMERS Ventures. We're an early stage tech VC based officially in Toronto. I'm on the San Francisco Bay Area team.
Lynn?
Great to see you again, Lisa, as always. I'm the founding and managing partner of Define Ventures. Define Ventures is an early stage digital health only fund. We are incredibly sector focused. We have 3 funds and over 21 companies in our portfolio and really invest at the earliest stages of incubation, seed, Series A, Series B, and really happy to be here with you.
Great. Thanks a lot, Lynn. Ned?
Yeah, Ned Sheets with Affiliate Capital. Been investing in the healthcare space now for, I hate to admit, but over 30 years. 25 of that in venture, running and starting Affiliate Capital, where we invest in early stage up to Series B, similar to Lynn, across the digital health space and the medical device space.
Thanks, everybody. And I should probably say I'm an advisor to 4 different funds, and all of which touch the digital health space in different ways and different stages, and have also, like Ned, been doing this for an awfully long time. I thought maybe the place to start is with just the term digital health. I myself have been quoted saying that I think it should die as a term, even though I do use it as a shorthand still. But I guess I'm wondering what you guys think. What is digital health, or maybe what isn't digital health? I think now it's become very popular to call everything digital health, especially and including things like services companies. And so I'm curious where you guys draw the line. Maybe I'll start with you, Lynn, since you have kind of a very prescribed focus. Where do you draw the line and say it's not really digital health, it's something else?
Yeah, I really think that we really think about it as the tech enablement of the healthcare industry. And so on the services side, Lisa, and what you're talking about, we will invest in tech-enabled services like Atia, where we have virtual and bricks and mortar components. We also have models that are purely direct-to-consumer, virtual only, such as HIMSS, Found, and Folks, which we've backed. And so I would say we also look at integrative plays that also could include hardware. So it might not be the answer you want, Lisa, in some ways, because I think as long as we feel like tech is a leverage point for rapid scaling or increased data or better consumer user experience, we will kind of put it in this terminology. We have our own analogy of 5 areas that we look for, which are, we call them consumer gateways, data liquidity analytics, tech-enabled services, as well as digital therapeutics and full stack vertical reimaginations. And so it incorporates a lot of things that we just talked about and I talked about, where technology is really enabling the healthcare system to really innovate.
All right. So Marissa, I see you nodding emphatically. So I'm wondering if you would change anything or disagree or add to what Lynn said.
Yeah, I agree with a lot of it. And I think there's always going to, from an investor point of view, there's going to be differences based on just the inherent stage of businesses that you're looking at. But I think I come at it from a very unique angle because in a former life, I was a market research analyst at CB Insights. So I was constantly, we talked about it all the time. We were redefining our definition of digital health and what companies were in the category versus not in the category, every few months. So it's, I think there's 2 main buckets of digital health, and this is more from the OMERS Ventures point of view. There's the actual tech developers. We don't look at med tech there. I think there's businesses probably more on the tech-enabled services side that might be using or integrating devices in some sort of way. But we are not a med tech investor. We see that as a discrete category. And then the second category in digital health are the companies that are using that tech. So those tech-enabled services. I think the second bucket is obviously the one that's murkier. And you could basically say every healthcare services company is using digital tech these days to some degree, which would mean the entire healthcare industry falls under digital health. If that's how we're going to continue to use it.
Make my point for me.
Yeah, we're going to continue to use the term digital health for anything that's using digital technology, then like I do think it loses its meaning as a discrete category. But if we reserve the term only for companies where tech is the foundational backbone, and I love what Lynn said, the like leverage point. If tech is the foundational backbone that's truly enabling new types or better quality or lower cost healthcare, then I think there's still value in that definition. But it really comes down to how we're defining tech-enabled services and not digital health as a whole.
It's interesting because by your description, you could call Bayer a digital health company in some respects, although I don't think they'd say that.
Yeah,
Ned,
that's the part of it that I.
Yeah. I mean, Ned, you have been a med tech investor traditionally, moved over to digital health, such as it is. Where's the line between those things, or is it completely blurred now?
I think it's pretty blurred. I think it's all pretty murky, at least in the way we look at things. And you could clearly say all imaging companies are digital health companies because they rely on digital technology based in silico, right? So I think it's a murky area. I kind of look at back when I was investing early and all through the 90s, kind of everything was an internet company, right? Or, maybe at the turn of the century, everything was an electricity company. I don't know. Digital to me is a foundational tool on which to build enterprises and great stories, whether those be services, whether those be tech, or whether those be something else. And so we try not to define it purely as digital tech or digital investing. Candidly, you kind of have to in today's world because people are asking, well, what's what? But I would say it is a strong continuum across the board, from a device company that may be a pure catheter to lots of imaging companies with AI built under that's basically leveraging AI in the cloud, to candidly even implantable devices that are leveraging AI in the cloud. So it's pretty great.
So let me go to another, word that everybody loves to hate and hates to love, which is platforms. There's been just tremendous disaggregation in healthcare with the onset of the digital, world. And there's, been just sort of this creation of hyper vertical and verticals and hyper verticals that are pretty narrow in ways that we didn't used to value. And now, whether we like it or not, there they are. But there's also this tipping point that seems to be getting reached right now where, individually, a lot of these companies are not able to make it best on their own from a distribution standpoint, from a service standpoint. At what point does everything have to be rolled up in M&A? Are we to the point where platform is the only good investment, or are we still looking to expand into hyper verticals?
Yeah, I think, and I'm newer to the VC world, so Lynn and Ned, I'm sure you have more experience to draw from. But what I would say is I think we can get to an answer by just looking at like what's driving the aggregation of platforms right now. And there's really a few factors. One is that there's startups raising a ton of money at huge valuations and realizing that they might not be able to live up to their growth expectations by limiting themselves to one vertical. And so they're needing to supplement with inorganic growth. There's the interconnectedness, or the increasing recognition of the interconnectedness between physical, mental health, environmental, socioeconomic determinants, which really requires a whole person, multidisciplinary approach. And then there's the whole aspect of care continuity. It's a real problem. It's for virtual care providers and brick and mortar providers alike. And until there's true interoperability, that connects the data points across all of those players in the ecosystem so that they can share a longitudinal record, and also have a better way for assessing attribution. In a world where every care provider, or most care providers, are going at risk now, it's becoming more crucial to identify exactly which part of the care journey and which pieces of the puzzle were responsible for what outcomes. So I think that's when we'll be able to really have a completely interoperable ecosystem with disparate parts. But for now, it makes sense for players to roll up.
Lynn, what about you? You've invested in quite a few, very verticalized sort of companies. Are you still excited about? I know you're excited about your investments. I'm not asking you a question. I'm wondering if you're looking for more of those, if that's a sort of a model you want to keep doing, or if you're thinking now, no, these are the platforms I want to roll up more things into, or what?
Yeah, I think, Lisa, it's both. And it really depends on the category that we're talking about. Let's talk about direct to consumer, which, having been investors in some of the earlier platforms, how we think about it is, while there's hyper, if you will, specialization, there's going to be hyper platform on the back end. So, what do I mean by that? So, we incubated a company called Folks Health, obviously very specialized in the LGBTQ space, but we're really creating a platform of experience where we're doing the virtual care, the mental behavioral health. You can imagine where we might take it from there. HRT, obviously, we're in today, and where we could go with fertility and otherwise, right? So we're now creating, you can get a platform, but in a very specific segment of the population that we think really has had an unmet need and has a very different path and journey from a clinical protocol, clinical care perspective. And that's why we think that's so important in that case. On an opposite end, there are some areas that we think deep specialization is still really needed because we haven't, if you will, created the right solution sets. And not that we're in these companies today, but obviously we've looked at, GI as like an issue. We haven't made an investment there, but you can imagine how we're looking on some of the specialty care that I think does require some real deep end to end. And then on the opposite side, in terms of platform, we've looked at like the employer world, where for certain markets, we've partnered with a company called Centivo, which is very end to end. It's very platform. We're doing, if you will, the enrollment to the virtual care to the network portion, soup to nuts for an employer, and feel like that's the right play for certain segments. So again, probably not there's one answer, Lisa. I think it really depends on what are we talking about and what's the right play between the two.
Yeah, it's so interesting to me because I think on the one hand, it seemed very obvious to me that some of these categories of care would be better served individually, because very specialized ways. And then you get to a tipping point with some populations where now they have 11 different points of contact for care, not all within a health system, right? Which, granted, some of the health systems don't do such a good job at coordinating, but at least it's all together, sort of one place to call. So I don't know where the point is that this becomes problematic for patients, but I fear that with some of the more common chronic illness categories, for instance, it comes up soon. I think we're
Well,
getting
I
close.
think let's talk about even in, the folks case where we're now taking, if you will, more primary care like services. You can imagine other services that are specialized that need that. And then we're going to be a referral point, right? We are that front door to then refer to more, where the depth of the model is really important in some of these specialties. And so I think, there's an arc of how these work together over time and where do you think a platform solution should be. I personally think on some of the kind of, again, more, what is primary care? Let's even debate that. But primary virtual services up into kind of chronic and then specialization for the specialty cases.
Yeah. So Ned, I'm going to change topics on you because I know you think about this a lot. So we've had a huge run up in valuations in the digital health sector over the last, say, 3 or 4 years, but especially in the last 2 years, when all of a sudden people realized that it was sort of relevant, to do things digitally and virtually. Most of the valuations, or many of the valuations in many of the companies, probably the preponderance of companies, are not supported by traditional metrics, traditional sales and adoption levels and or stock market performance. A lot of the stocks, virtually all of them, are underwater from a stock price, IPO stock price standpoint. Now the stock market's weakened generally. What happens now? Valuations, are they going to come down? Are they going to bifurcate? Are they going to stay high? I mean, where are we in that? And what should entrepreneurs expect?
Yeah, I mean, it's interesting you talk about this. I have always found in my 30 years watching this that the private markets actually follow the public markets by about 6 months. And so, having gone through a number of these kind of cycles in various areas, I think what you see is when you see the late stage investors, the crossover investors, candidly, the public investors, and I used to work at the Janus funds for years, and They kind of got into the game late. We're the largest private equity investor from a public mutual fund perspective, and now you see Tiger, and now you see all these other groups doing the same thing. And then that all came crashing down. Whether it does or not, who knows? But I do believe that you've seen some less sophisticated healthcare investors getting into the healthcare area and the digital health with this perception that it's the same as technology. And my understanding of technology will therefore allow me to move into this healthcare space. What they don't capture is the long sales cycles and the difficulty of commercialization, the lack of interoperability, as Marissa talked about. Those things really slow down that revenue uptake. And when valuations start to come down and people start to see interest rates rising, you're going to discount significantly higher rates, and that really hurts your long-term, valuation. So I do think we're in for some valuation corrections, and you're going to see some of that money start to move out of the healthcare space, some of that late stage money. So, don't
Do
presume
you
that
think
money
we'll
will be
also
there.
see early stage investors go later, try to buy later stage risk at lower prices?
Possibly. I mean, you've seen so many people come into the late stage space, and they've been going earlier. I think a lot of the early stage investors, one, because you couldn't compete with the hundreds of millions of dollars being thrown at some of these deals, you stayed early stage. The problem with doing that is a lot of those companies have been built with an infrastructure that's unsustainable. And it's really hard to scale those businesses back and be successful. And so the early stage model tends to be a more capital efficient model. The later stage models, as they've been built over the last 5 years, have been a very capital spend model. And those don't interact very well. So I would just caution you have to be careful when you make those transitions to make sure that the infrastructure that you're investing in can be tweaked to really be capital efficient.
Yeah, it's an interesting time. I mean, it's probably a great time to have lots of money to invest because you can come in at lower valuations a few months from now, likely, and should ride the ride back up 10 years from now, as opposed to enjoy the slide down. I guess I'm curious if this ease of getting large amounts of capital at high valuations has created any sort of or affected entrepreneur behavior in any way that you think is either good or bad, and what is likely or needs to change there to ensure sustainability through these roller coasters that are to come.
Yeah, I mean, I think that on the spectrum, if you will, of there are some entrepreneurs, and I'll mention some on the very end of the spectrum where you're starting to see they did a raise, and then 6 months to 9 months do another raise, and so on and so forth. And you have to ask yourself, did they really build to some milestones? Did they take advantage of the capital markets, and do they have the solid fundamentals to support what was most likely some type of step up in valuation within a very short time period? And so I think that age and era has probably dissipated. Haven't seen those types of headlines, if you will, in 2022. And so I think we always go back and as early stage investors get back to like solid fundamentals. We will always invest in those solid fundamentals and building that. So I think that behavior, Lisa, has kind of, if you will, gone away. I think we've returned to a more normal. Now, where do we go from here? We can also discuss, but there was a day and age in 2021 where deals would go in 2 to 3 weeks. Right? You meet an entrepreneur within 2 weeks, they might have a term sheet and everything's done in that time period. And so we were running sprints within that time period. I think today things have come to a more normal state of, multiple months, let's say that. And I think as always, valuations lag public markets, but there have been some pretty strong changes in the public markets that I think we just see, that general softening already absolutely bleeding throughout our current private companies as well. And so I think that, I see it as a return to normal more, and making sure that you have those solid fundamentals. We were always looking for the right go-to-market motions and capital efficiency from day one, and not really investing in momentum plays where there's a couple bright, shiny names and people just adding capital, not really wanting expertise, or that there are solid milestones behind that. We've always shied away from that in general.
Marissa, what do you want to add to that?
Yeah, just on the point about entrepreneur behavior, I think in digital health particularly, whether it was because of the sheer volume of cheap and easily accessible capital, or because of the temporary regulatory relaxations during the public health emergency, there's just been a lot of opportunism and growth hacking over the last year or so. And that's not always a bad thing. But I do think ethics come first. And the bar is higher in a lot of ways in healthcare. The potential to do harm is just so much higher than in other industries. And we're starting to see some signs that maybe to get to growth milestones, certain founders or executive teams had to make decisions that were advantageous during the public health emergency, but might not be the best thing for the healthcare system in the long run. So that's not a generalization of all founders in digital health. But I do think right now there's this weird confluence of like really cheap available capital and a lot of relaxations that are changing the opportunity set for founders as they're thinking about their growth milestones.
So if you had to handicap it and say 1 year from now, each of you, and ask you just for a quick one number answer, what percentage of the digital health rounds are down rounds? Ned?
Well, that's a great question. Probably a third or slightly more.
Lynn?
That's where I was exactly to go. I go 3rd to 25%.
Marissa?
I was going to say 25. I think there's going to be a lot of debt raises that just kick the can down the road. There's not really a publicly disclosed valuation discount, but I think 25 is probably where the data will show, at least.
I think in the last 2 cycles that I've survived through with Ned, that the numbers were like 50 to 60% of the companies had down rounds if they survived at all. And they had pretty material reductions in force and things like that, and resets and a lot of insider-led rounds for those companies that had promise but just couldn't raise capital outside. And I gotta believe that if history repeats, which it tends to do, that's what we're going to see. So we'll see. We can all, buy each other, a drink over that bet. What about you guys? Are you changing your investing habits in light of this discussion? Any bad habits you need to break or change? If you go from a sort of a 3-week investment cycle to a 3-month investment cycle, that's pretty different, right? So what are the top 3 considerations you're taking in any new deal right now? Ned, what are your top 3?
Yeah, I mean, still management and team is number one, will always be number one. The next thing though is, we're really looking at syndication risk, right? It is really important to have other parties at the table because in these times, Lisa, as you talk about, you need that capital to kind of get these companies through when the fundraising spigot dries up. And so that would be certainly kind of the next thing that we're looking at is their staying power, and then just capital efficiency and to Lynn's point, fundamentals. Can this, is this business a fundamentally good business, and can you run it in a fundamentally good way?
Lynn, what about you?
Yeah, always team. I think how the vision of where they go, we always call it almost like V1, V2, V3 of the vision of what they're building. And then the go-to-market business model, right? Which nests many things in there, obviously, like capital efficiency, like gross margin and other areas that we've always looked at. So I wouldn't say that we're changing anything about, I think, just the time to process, Lisa. And this time period allows for deals that might have been, quick no's before. We might do one more turn than we typically would have done back in 2021, which I think is beneficial in a lot of ways for everyone, because it is important. These are 10-year plus, sometimes relationships, and it just benefits everyone that we really are, that convinced about the go-to-market motion, how we can help and partner, and that entrepreneurs understand how we can do that as well.
What about you, Marissa? What are your top 3?
Yeah, I was going to say, the considerations I think are the same. It's more a question of the changing of the approach. I don't think OMERS Ventures has changed their approach at all during the cycle in 2021, and I think it's going to stay the same. We're not going to chase high flying or fast moving deals. We're going to stay disciplined, stick to our process, sharpen our pencils. There's a reason we have a process to begin with. It works. It builds conviction. It on both sides of the table. It allows us to build those more intimate relationships with the founders and the executive teams, and gives us to show a chance to show how we can add value. I think these are all things that we're saying across the board, and ultimately it helps get us to conviction on a number that on valuation. And in moments of volatility, I think you just got to stick to your guns. That's what we're going to do.
Okay, cool. So related perhaps, but different. Lots of companies in our space haven't gotten to profitability yet. They're really mostly these companies been pouring money into growth. And that it's interesting because we used to think of health IT or digital health, didn't used to get called that, but as companies that were kind of the opposite. Med tech and pharma is where you had to pour in money and wait for the outcome. But companies in the tech space, you could get to profitability faster, grow faster. How much are you thinking about the trade-off between growth versus profitability, and where's your ROI focus these days for companies that you're investing in? Marissa, you want to go first?
Sure. I think first and foremost, I think growth is the first consideration. Is this a big enough market? Is it a venture? Does it have the potential to produce a venture scale return on a top line perspective? Then we start thinking about profitability. But I think really it comes down more to burn right now, especially given what we're saying is going to happen with the deal flow and just the pace of deals and the ability to raise at successively higher valuations. I think that's more of what we're concerned about in the near term, is how companies are managing their burn, not necessarily getting to SaaS gross margin in the next year or two. I think there's room to get there, but they need to. If there's any chance that they need to raise capital again in the next 18 months, then we need to think about their ability to meet milestones in that period.
I haven't heard people talk about burn rate in a while. It's refreshing to hear that term again. Ned, what about you?
Yeah, I think similarly, what I like to look at in these stages is kind of what's the optionality in the business. Meaning, if we can throw money at it and we can raise money at reasonable valuations and we can accelerate the growth rate, great. But if the company doesn't have any optionality to scale back and reach profitability and lower those burn rates significantly, that's concerning to us. And so, we want to be looking at companies that intrinsically have some of that optionality where you can play with the accelerator depending on what the financial conditions in the world are like. And so we just, we kind of sharpen our pencils on that and just make sure that we feel before we make investments, okay, what if something goes wrong in the markets and there's no access to capital? What can we do with this business?
Mm-hmm. If you think about the time between rounds, you mentioned it already, it's been compressed pretty dramatically for a lot of companies. Do you think the discipline of managing cash longer is going to become a much more serious effort on the part of entrepreneurs and boards? Are we shifting focus now from pour the money on to grow, and be the market leader to just hold on to the money to let it last? Or is that a shift that we're going to see?
Yeah, obviously I think those types of conversations are happening in the boardroom, but at the same time, remember, we are in venture here. And what's so important is, I always say, is that toggle point of when do you hit the gas pedal? And that's so important. And then when do you say, no, there's still product market fit to be had here, and we need to conserve, if you will, while we're still kind of having that go-to-market motion. And then there's other cases where we have the go-to-market motion, the opportunity set is here. Let's not forget we're in venture and we're in a really emerging space where platforms, to your point, Lisa, I would say we've still not seen the Apple of digital health. We've still not seen so many platforms in a winner-take-all type of scenario. And so, this is measured, of course, but I think that's really the art, obviously, at more of the kind of late Series A, Series B, Series C, is these discussions at the boardroom. and having that mental map of when to hit the gas and when to conserve, because we're still figuring some things out, is just incredibly important. I mean, obviously it's like that for all stages, but it's truly, I think, at that late A, B, that you've got to make really concerned investments and be really smart about where you're putting the gas on and where you're, kind of holding to grow and conserve.
And I'll just add to Lynn's
Now I
comments.
have to ask you, what company? Hold on, Ned. Hold on.
Yeah.
I need to know now from Lynn, who is the number one candidate to become the Apple in digital health?
Oh, I mean, at least from how I think about it, we obviously, Apple in a certain way of being the consumer brand, one of our first investments, and truly the very first investment at Define, is Tia, and really to own the front door of women's health. And let me just add, Lisa, to your point, when we talk about Apple, who are the people with buying power in healthcare? And that is women. And I always say, if you own the major consumer / chief medical officer of the home, you own healthcare. And so this is a company.
If you were wearing a black robe in Washington, D.C., you owned healthcare as of this week, but I'm not.
Oh my goodness. Let's
not go there.
A whole nother, 45 minutes in that direction. Yeah. But how appropriate in some ways, honestly, that we just announced that we're having 10 clinics in the Bay Area with UCSF to really, if you will, have a regional presence here. And then, current events happening. But I think what's so important is, like, where is that brand? Who is that front door? There's so many models going after it. I think the flawed nature of it is, particularly in healthcare, we're retailers without a consumer point of view. And I think that's why, some companies like Tia, for instance, I really think can be that consumer point of view.
What about you, Ned? I'm sorry I interrupted you, but you can add what you're going to add, but I'd love to have you answer the same question. Who's the best candidate to be the Apple of digital health?
I have no idea. I mean, it is such a hard, like, that concept of, would there ever even be an Apple of digital health in our world? I don't know. This is not, as much as we like to think that healthcare is moving in a consumer-centric direction, it is still driven by a payment system that is, deeply flawed. And that's not necessarily going to change. And that really, those are two very different constituents to serve. And so, can you be successful serving both of those? I don't know. I think they're very different skill sets. So I'm not sure that I think there will be kind of an overarching big consumer play like an Apple or pick your name.
Marissa, do you have a point of view on that? Who do you think will be the Apple of digital health? Or maybe it's the Amazon, whatever, the big gun with the best, enterprise value?
I have no idea. I mean, I don't know that Apple, I think Amazon's a great example. And, like, there's very good reason that Amazon could be the Amazon of digital health, they're starting with employers, but they've got a captive audience and a loyal consumer base. And if they succeed with the employer segment, then I see no reason why they couldn't go direct to consumer.
Interesting. Well, we're getting close to the end here. So maybe I'll ask you each for one actionable piece of advice that you give for entrepreneurs to improve their odds of success in fundraising and in building their companies. What do you wish they would do that they don't do enough of before they come to you for money? Marissa?
Yeah, I think a lot of it, and maybe it goes back to our conversation about, like, what is digital health, is just understanding what venture money is good for, what types of businesses show a venture scale return. I think we're seeing a lot of businesses that were like, yeah, this seems more like a PE playbook, and I wish that they just went and sought out PE money, or they did some sort of a different alternative financing vehicle, because it's just not it's not going to scale. It's not going to show us the power law that, like, we would need to invest our money. So I think it's just really being honest with yourselves. And, like, you don't have to come in telling a super hyped up growth story if that's not what it's going to be. I think sometimes we need to just be honest and have, like, a real talk about, like, what is the potential of this business, and is VC the right source of funding for what you're looking to build?
What about you, Lynn? What's your piece of advice for entrepreneurs before they come to you for money? What do you wish they'd do or know?
Yeah, I mean, I think, laser like focus on what I call V1 and owning that inside and out from an understanding if it's an insight or the data, why V1 is the right thing, but then quickly evolving us to what does V1 earn you the right to do for V2, V3, and the vision of the company, and really being able to articulate that clear story and trend line is incredibly important.
What about you, Ned?
Yeah, I mean, it's a hard one, but to be an entrepreneur, you have to be passionate. You have to be a believer in the story. But I go back to what Marissa said but you also got to be brutally honest with kind of what is this business. And I just wish the entrepreneurs, it is strikingly few who really understand the market they are going to serve and what that commercialization complexity really is. So you see these expectations that are completely unrealistic, and we try to talk them down to say, look, this is not how this is going to scale. Here are the experiences you're going to go through. And so maybe a little bit more kind of studying of the market and really looking at who are the other companies that that have done this before and what were their rates. And so just, that's kind of would be my suggestion. Make sure you know what you're getting into.
Great. Well, thank you guys so much for your time today. Thank all of you who are listening to the panel. I hope you got something good out of it. We are calling it done.
Thanks all.
Take care.
Thanks, Lisa.
Thank you.